Welcome back to another trade video. If you're new to the channel, I usually do weekly videos going over my trades for the week and talk about what trades I'm taking for the following week. This video is part of a new series where I talk about the option strategies that I use. And in this video, I'll be going over how to trade covered calls in Robinhood. If you use Thinkorswim, I also have a video for that, and you can feel free to check that out. Before we get into how to trade covered calls in Robinhood, don't forget to like and subscribe so you can stay up to date on all of my trades and trade strategies. This video assumes you have a general knowledge about what call and put options are and know that you can buy and sell options. If you don't, I recommend checking out some videos online before watching this to get just a general sense of the terminology around options and stocks. And I'll be doing a video on those topics in the future. So now let's go ahead and jump into trading covered calls in Robinhood. The first step is I want to do a quick review on what is a covered call. So basically a covered call is owning the stock and then selling a call option against it. And because each option contract is equal to 100 shares, you need to own at least 100 shares in order to sell one option contract against it. So the way I like to think about it is you have to pay money to buy the 100 shares, but you get money for selling the call option. I'm going to go ahead and jump into a live example on Robinhood. And here you can see that I have Apple pulled up. So Apple's currently trading at $120.02. So for this example, let's pretend that I buy 100 shares of Apple. And as you can see, I've put that here. And that cost would be $12,000. So first of all, you would need $12,000 in order to buy 100 shares of Apple. After you've gone through and bought your 100 shares, you can then sell the call option against it. So what that would be is going down here to the Trade Apple Options button, clicking on that. You want to make sure you have sell selected, not buy, and then you want to make sure you've selected call. And then you want to pick your expiration date. For this example, I'm going to go 2 weeks out. So that would be in April, which is April 2nd is when this would expire. And we're going to go ahead and sell the $125 strike price call option. So if I was to sell this call option, you can see it right here, $125 call expiring on April 1st for $1.09, total credit $1.09. And here you can put in the number of contracts. Because we hypothetically own 100 shares of Apple, we could trade one contract. And in terms of the actual limit price, I like to go for some number in between these two numbers, the bid and the ask. So in this case, I'll go with 109 for the example. And here you can see minimum credit, $109. So if you submitted this trade and it got accepted, you would then get $109 for selling a call option at the $125 strike price expiring April 1st on Apple. If you don't have 100 shares of Apple in your account, you would not be able to sell this call option because you need that as collateral for this position. Now, going back to the Apple chart here, I want to explain what's happened. We own 100 shares at $120, and we have sold the $125 strike price call option. So that would be right around this level. So let's pretend now that Apple kind of moves around, but by the time expiration comes around, Apple finishes and stays right here at $120. It finishes below the $125 strike price. What happens is nothing happens. The option expires worthless. You get to keep your total amount of premium, which was $109 for selling that option, and you still continue to own your shares of Apple. In another scenario, let's say Apple all of a sudden skyrockets up and goes up to $130. In that scenario, what happens is you get to still keep your premium for selling the call option, so that's $109, but then you are forced to sell your 100 shares at $125 because that was the strike price of your option. So 125 minus 120 is $5 times 100 shares is $500 in profit. So in that scenario, you would get $500 plus the $109 for selling the call option. Now that we have a general sense of how to trade covered calls in Robinhood and the two different scenarios of what can happen, I want to jump into some tips that I like to take into consideration when trading covered calls. Tip number 1 is that you will get higher premium the closer you are to the price. So as you can see here, the current share price is $120.02. And if I was to sell the 121 strike price, which is about $1 away, I could get $239. Whereas if I was to sell the $130 strike price, I could only get $38. The next tip is that you get higher premium when there is more time until expiration. So in this example, we're looking at April 1st, and if you look at the $125 strike price, you get $109. Whereas if you were to go, let's say, a couple of weeks further out to April 30th and look at the same strike price of $125, you would now get $378. The third tip that I like to take into consideration is the expiration date. You don't always have to wait until expiration. So for example, if you look at this call option expiring March 26th or next Friday, you don't have to wait until expiration to close out the contract. So for example, if I sold this 125 for 51 cents, which would be $51, and let's say the price started to drop lower, I could buy back this contract for a certain percentage of the profit. So maybe I wouldn't make $51, but I would maybe make $30 or $20. And that's always an option. You don't have to wait until expiration in order to close out these contracts. A couple of other things that I like to keep in mind when trading covered calls is that you have to be ready for your stock to get taken away. So for example, if the stock did all of a sudden go up past my $125 strike price and it finished at $126, there's a very high chance that my shares would then get taken away at $125. And that's something you have to be okay with. My last tip is that I always like to keep a little bit of extra money in my account in case I need to roll a position. And what that means is basically you close out your current position and then you sell another contract either for a later expiration or at a higher price. And the reason for doing that is you either want to continue holding the stock or you're trying to adjust the trade. And I'll do future videos going into more detail about rolling a position and things to take into account. And so that's everything in terms of how to trade covered calls in Robinhood and some of the things that I take into consideration when placing these trades. I have a video out on my top 5 tips for selling covered calls, so feel free to check that out. I'll put the link in the description below. As always, feel free to leave any questions or comments down below and I'll make sure to answer those. And I'll see you all in the next video.